Hey everyone, and welcome to this deep dive. Today we're going back in time to 1977.
Oh, wow. 1977.
Yeah, the year of bell-bottoms disco
Ah, the disco era.
and the dawn of personal computing. And we're going to be looking at Warren Buffett's letter to Berkshire Hathaway shareholders,
Okay.
not just for the financial figures, but for the wisdom that we can glean about business and investing that's timeless.
I think what's really fascinating about looking at these letters is that even though it was a very different world back then,
Right?
a lot of these principles and insights are still so applicable today.
Absolutely. Yeah, it's like having this masterclass in decision-making available to anyone who's willing to listen.
Yeah.
So we've got excerpts from the letter itself, and we've got some guiding questions to kind of help us unpack the most important takeaways.
All right.
So think of this as like a shortcut to absorbing the brilliance of Warren Buffett.
I like it.
Okay, so 1977.
This is a particularly interesting year, I think. It was a time of transition, both for the economy and for Berkshire Hathaway itself.
Okay, so let's jump right in.
Yeah, let's do it.
The letter kicks off with Berkshire Hathaway's 1977 operating earnings,
Okay.
22.54 per share.
Not bad.
Yeah, slightly exceeding predictions.
Yeah.
Not too shabby.
It's worth noting, though, that some of those earnings came from capital gains made by blue chip stamps,
Okay.
a company that Berkshire Hathaway had a stake in.
Got it.
So it wasn't all purely from their operating businesses.
Okay. So let's break down those operating businesses.
Okay.
So textiles were struggling,
Yeah, they were.
but insurance,
Right.
particularly National Indemnity Company, was really shining.
Absolutely. National Indemnity was a real powerhouse for them at this time.
Yeah. And this is where Buffett's thinking gets really interesting
Okay.
because he warns against getting fixated on earnings per share.
Mm.
Why is that?
I mean, that's the number that everyone usually focuses on.
Yeah, it seems like the most important number.
Right. And he gives this great analogy about a savings account. So imagine you have a savings account, and the interest you earn is added back to the principal.
Right.
So the next year, you earn interest on a larger amount.
Mm.
Even if the interest rate stays the same, your earnings grow simply because the base is bigger.
I see.
And companies can do the same thing. They can grow earnings just by getting bigger, not necessarily by getting better.
Ah.
So earnings per share can be kind of misleading if you're really trying to gauge management performance.
Oh, fancy.
So what Buffett really focuses on is return on equity capital,
Okay.
which measures how effectively management is using the money invested in the business.
I see.
And Berkshire achieved a 19% return in 1977,
Wow.
which is impressive by any standard.
That is very impressive. Yeah.
But he also says he wasn't getting complacent.
Okay.
He anticipated challenges in maintaining that rate because he expected shifts in insurance underwriting margins
All right.
and an increase in equity capital as well.
Right. So he was always looking ahead,
Always looking ahead.
anticipating those headwinds.
Yeah, exactly.
Now let's talk about those textile troubles.
Yeah,
That seems like it was a constant source of frustration.
it really was. And, his honesty about it is striking.
Yeah.
He admits to misjudging the situation. He highlights, his willingness to learn from these mistakes.
Which is something that we see throughout his whole career.
Exactly.
So why not cut their losses and focus on more profitable areas?
Yeah. Why stick with a losing hand?
Yeah.
Well, he actually outlines 3 reasons for staying in textiles.
Okay.
He says, first of all, is commitment to their employees
Right.
in New Bedford and Manchester.
Sure.
Loyalty to the management team who are working very hard to try to turn things around.
Right.
And the possibility, however slim, that textiles could still generate some profit in the future.
It's a reminder that business decisions aren't always just about the numbers.
Right.
There's a human element too.
Absolutely.
Yeah. And it's interesting how this contrasts with his approach to insurance.
Yeah.
Because even with some bumps in the road, insurance seemed to have this incredible resilience.
Yeah, he even says, it is comforting to be in a business where some mistakes can be made, and yet a quite satisfactory overall performance can be achieved. He contrasts this with textiles, where he says even the most skilled management might only achieve modest results.
Yeah. It reminds me of his famous analogy about swimming with the tide,
Right.
seeking out tailwinds rather than fighting against headwinds.
Yeah,
And insurance was clearly a tailwind
absolutely.
for Berkshire.
Yeah.
So you mentioned bumps in the road
Mm-hmm.
in insurance. What were some of the challenges that stood out to you?
Yeah, well, there were issues with a new surety operation,
Okay.
an expansion into the Miami auto market that didn't pan out as expected,
Wow.
and a problematic aviation arrangement.
Okay.
They also had ongoing struggles with their workers' compensation operations in California.
So even the most successful businesses face setbacks.
Of course.
Yeah. But importantly, the overall insurance operation was thriving.
It was.
Their premium volume had exploded from just $22 million in 1967
Wow.
to a whopping $151 million in 1977.
That's incredible.
That's massive growth.
Yeah.
And they did it all without issuing any additional Berkshire Hathaway stock.
Yeah. How did they manage such rapid growth?
That's a great question. It was a multi-pronged approach.
Okay.
So gains in National Indemnity's core businesses, creating new companies like Cornhusker Casualty and Lakeland Fire, acquiring existing firms like Home and Automobile and Kirkling Reinsurance,
Okay.
and expanding into new products, particularly reinsurance.
Right.
So it was a masterclass in strategic growth.
Yeah. They weren't just sitting on their hands. They
Yeah.
were actively building and diversifying and making smart acquisitions.
But he also repeatedly emphasizes the importance of having the right people in place.
Yeah, he does. He singles out individuals like Phil Leach and Roland Miller at National Indemnity,
Okay.
John Seward at Home and Auto, and John Ringwalt, who led their home state operations, which includes companies like Cornhusker Casualty.
Okay.
He also highlights Milt Thornton, who joined through the acquisition of Cypress Insurance Company.
This focus on people, this human element, seems so central to Buffett's philosophy.
Right.
He gets that businesses are ultimately driven by the individuals who run them.
Yeah, and it's especially crucial in insurance. He points out that insurance companies are essentially selling promises.
Okay.
And the marketplace is fiercely competitive.
Right.
So in that environment, the quality of your management team is just absolutely essential.
Okay. So we've got this booming insurance operation generating all this cash.
Yeah. What happens next?
Yeah. What happens next? This is where things get really interesting for those of us who are fascinated by Buffett's investing prowess.
Right.
So over the preceding 2 years, insurance investments had surged from $134.6 million
Yep.
to $252.8 million,
Wow.
fueled by that cash flow.
All right. So where was all that money going?
Yeah, spill the beans. Where was Buffett putting all that cash to work?
Primarily into equities. He was a big believer in owning pieces of businesses, not just trading stocks.
Okay.
And he outlines his criteria in the letter for picking stocks. He says that he looks for companies that he understands,
Okay.
with favorable long-term prospects,
Right.
run by honest and competent people,
Okay.
and available at an attractive price.
Sounds familiar.
Classic Buffett.
Yeah. Focus on the fundamentals. Ignore the hype.
Yeah.
Invest for the long haul.
Exactly. And when he finds those companies, he's not afraid to take a large position, not for a quick gain,
Right.
but because he believes that over time, their strong performance will create value for shareholders.
Yeah. It's like partnering with businesses that are built to last.
Exactly.
And he gives a perfect example.
Yeah.
Capital Cities Communications.
Really about that one.
So Berkshire invested $10.9 million in Capital Cities in 1977.
Okay.
But here's the interesting part.
Okay.
While the investment generated about $1.3 million in earnings,
Okay.
only $40,000 of that,
Oh, wow.
the dividend payment,
Okay.
showed up in Berkshire's operating earnings.
Okay. Why does that matter?
Because it shows that Buffett is not fixated on these short-term earnings fluctuations.
Right.
He's thinking long-term about how that underlying business is performing and how that creates value.
Right.
He even states that buying the whole of Capital Cities would cost him twice as much,
Okay.
and he wouldn't manage it any better than the existing team.
Interesting.
So non-control ownership was the smarter play in this case.
Brilliant. It really challenges the assumption that control is always best.
Right.
Sometimes owning a piece of a great business is enough.
Exactly. He also talks about Illinois National Bank,
Yes.
which was another consistent performer,
Yeah.
known for its high returns on assets, low risk, and high liquidity.
Okay.
Another example of his preference for businesses that are prudent and profitable.
Right. And we can't forget about See's Candies.
Ah, yes. The sweet success story?
The cherry on top.
Their pre-tax earnings grew from $4.2 million to $12.6 million
Wow.
since 1972,
That's impressive.
with minimal additional investment.
Yeah. Not bad for a company in an industry with practically no growth.
Right. It shows the power of a durable competitive advantage,
Yeah.
like C's brand loyalty, to generate these outsized returns even in a slow-growing market.
Absolutely. So much to unpack here.
I know, right?
Business performance, investment philosophy, and then all these unique Buffett insights.
Yeah, I feel like I need to reread this 1977 letter with fresh eyes now.
It's a real treasure trove, that's for sure.
Yeah.
And the best part is many of these principles are still so relevant today.
Yeah.
Long-term thinking, focusing on fundamentals, quality management, the power of compounding.
Right.
These are timeless ideas that benefit any investor.
But wait, there's more.
Oh, there's more.
We've only scratched the surface of Buffett's 1977 letter.
All right.
Ready to keep digging.
Absolutely. Let's dive back in.
Okay, so remember our discussion about the importance of the right people? Especially in insurance, where trust and judgment are so paramount.
Yes. It's like he was saying that the character and competence of your team can be even more important than what you're selling.
Exactly.
Yeah.
And this leads to this key point that he emphasizes,
Okay.
that in the long run,
Yeah.
reputation and trust
Uh-huh.
are a business's most valuable assets.
So true.
It's like he's saying that any short-term gains through questionable means
Yeah.
come at a steep price.
Right. It's that long-term thinking. Again,
Yeah.
true success is built on ethical behavior. And this applies to everything.
Right.
You know how you treat your employees, how you manage your finances, how you communicate with investors.
It's a timeless message.
It really is. Just as relevant today as it was in 1977.
Yeah. In a world that's obsessed with winning at all costs,
Yeah,
Buffett reminds us that there's a better way.
There is. It's about building businesses that are both profitable and sustainable,
Right.
creating value for everyone, not just a select few, and investing in companies that share those values.
It's led by people you can trust.
Yeah, integrity isn't optional.
Right.
It's essential for long-term success.
Absolutely. Every investor should consider that.
Yeah. What questions does this raise for you?
It makes me wonder, how can we as investors better evaluate the integrity of a company?
That's a great question.
Yeah.
Something I think about a lot.
Yeah.
We could probably do a whole other deep dive just on that topic.
Right.
But for now, let's shift gears back to something we touched on earlier.
Okay.
The insurance industry.
Ah, yes, the heart of Berkshire Hathaway's success.
Exactly. So Buffett dives deeper into this world in his letter,
Yeah.
specifically the concept of underwriting.
Okay.
So he talks about how the industry had enjoyed these big rate increases in 1976 after a couple of tough years.
Yeah.
But those increases didn't immediately translate into higher earnings.
Right. Insurance policies are typically written for a year at a time.
Right?
So it took until 1977 for the full impact of those higher rates to show up in the numbers.
So it's that lag effect again.
Turning a giant ship.
You make a change, but it takes time to see the results.
Right, exactly. But Buffett saw the pendulum already swinging the other way.
Oh,
He estimated that costs were rising almost 1% per month
okay.
for their insurance businesses.
Wow.
This was driven by two factors:
Okay.
monetary inflation,
Uh-huh.
the rising cost of goods and services,
Right.
and what he called social inflation.
Social inflation, that's interesting.
What is that?
Yeah, what's that all about?
Yeah.
Well, he's talking about the expanding definition of what's covered by insurance.
Oh.
So think increasingly generous jury awards.
Okay.
Or broader interpretation of liability.
Hmm.
So the cost of claims rises even if the underlying events themselves aren't happening more frequently.
So costs rising, rate increases slowing down.
Yeah,
That's a recipe for shrinking profit margins.
you got it. And Buffett anticipated this.
Hmm.
He predicted declining underwriting margins in late 1978.
Oh.
So this raises a crucial question for insurance companies.
What's that?
Do you keep writing policies at lower margins to maintain volume?
Oh.
Or do you hold firm and risk losing business?
It's that classic dilemma.
Yeah.
Short-term gains versus long-term sustainability.
Exactly.
So what did Buffett recommend?
He stressed the importance of what he calls unusual managerial discipline,
Okay.
resisting the temptation to chase unprofitable business,
Right.
even when your competitors are doing it.
Hmm.
It's about quality over quantity,
Right.
and it's a principle that applies to so much more than just insurance.
Absolutely. Sticking to your guns even when it's tough.
Yeah,
But he also highlighted examples of teams that navigated this well.
he did.
Success stories even in a challenging market.
Yeah, absolutely. He praised Phil Leach and the National Indemnity team for their outstanding underwriting performance,
Okay.
even under pressure.
Right.
And their discipline generated strong profits
Right.
and freed up more capital for investments.
And speaking of investments, this is where things get really exciting, because we get to peek inside the mind of one of history's greatest investors.
That's right. And remember, this is 1977,
Yeah,
long before Berkshire Hathaway became a household name.
right. He was still under the radar, sharing his wisdom with those who were paying attention.
Exactly. And he reiterates his approach to investing in this letter.
Okay.
He views stock purchases as if he's acquiring entire businesses.
Right.
And he looks for those same qualities we discussed earlier. Understandable companies with favorable long-term prospects,
Right.
run by honest and competent people, available at a good price.
It's like a mantra. Ignore the noise, focus on the signal,
Yeah.
tune out the daily ups and downs.
Yeah.
Pay attention to what truly drives value.
Long-term thinking.
Yes.
Yeah.
And when he found those companies, he was willing to bet big.
Yeah.
That $11 million investment in Capital Cities Communications.
Right.
A significant sum back then.
Yeah.
But he saw the value, and he wasn't afraid to back his conviction.
He was in it for the long haul.
It's a lesson in going against the grain, thinking differently than the crowd.
Right. And what about Illinois National Bank?
Another fascinating story.
Idea.
The bank consistently outperformed,
It did.
earning exceptional returns while maintaining low risk and high liquidity.
Pretty impressive.
Yeah. He attributed this to its founder, Gina Fionndebig.
Okay.
But at 80 years old, Abegg recognized that it was time for a successor,
Right.
and he chose Peter Jeffrey to take over.
Wow.
It speaks to Abegg's humility and foresight.
It does.
You know, he built an incredible business,
Mm-hmm.
but he knew it needed to continue thriving even after he was gone.
The power of long-term thinking.
Yes, both for individuals and businesses.
Mm.
It also reinforces Buffett's focus on surrounding yourself with talented, trustworthy people.
People you can trust to carry the torch.
Exactly. This emphasis on the human element is a constant in Buffett's letters.
It is. And it's not just large corporations. Right. Remember blue chip stamps?
Yeah.
He highlights the success of two subsidiaries,
Okay.
Wesco Financial, led by Louis Vincenti, and See's Candies, headed by Chuck Huggins.
See's Candies.
Yeah.
You can't talk about Buffett without them.
You can't. They're like the embodiment of his investment strategy.
A perfect example of a simple, well-run business with a strong brand and loyal customers generating these extraordinary returns.
It's incredible. Pre-tax earnings from $4.2 million to $12.6 million in just 5 years.
And with minimal extra investment.
It's amazing.
It's finding those businesses with a durable competitive advantage.
Yeah.
And letting them do what they do best.
Right.
But we're nearing the end of our deep dive.
I know.
Any other nuggets of wisdom that you unearthed from Buffett's 1977 letter?
It's amazing how much we covered.
I know.
You know, we've seen Berkshire's performance.
Okay.
We explored Buffett's investment philosophy.
Right.
We glimpsed his unique approach to evaluating companies.
Yeah.
We discussed earnings per share.
Yeah.
The insurance industry, the power of strong management teams.
What stands out to you most?
I don't know. It's tough to choose.
I'm struck by this recurring theme of patience.
Oh, yeah.
Patience in letting businesses grow. Patience in sticking to your investment principles. Patience in building a team that you trust.
Right.
It's a quality that feels so rare in today's fast-paced world.
You're absolutely right. And Buffett embodies that patience like few others.
He does.
Who would have thought that a letter written almost 50 years ago could still hold so much relevance today?
It speaks to the enduring power of his principles.
It really does.
They're not tied to any particular market cycle or economic trend.
Right.
They're timeless truths applicable to anyone, whether you're running a massive company
Yeah.
or just trying to make smart financial decisions in your own life.
Absolutely. What are you taking away from this deep dive?
I'm walking away with a renewed appreciation for patience, discipline, and integrity in both investing and business.
Yeah.
You know, true success isn't measured by quarterly reports or stock prices,
Right.
but by the lasting value that you create for yourself and for others.
Beautifully said. And on that note, I think it's time to wrap up our deep dive.
Okay.
I hope you've enjoyed exploring the wisdom of Warren Buffett's 1977 shareholder letter as much as we have.
Until next time, keep learning, keep questioning,
Yeah.
and keep seeking out those timeless principles that can guide you on your own path to success.